Hey, happy long weekend, everyone. It's Charles with all the best happening this weekend around the valley. I do hope you'll take a moment to pause and remember, as this holiday is especially revered by our nation. It's more than a kickoff to summer. Originally known as Decoration Day, in the early 1900s, it was designated as Memorial Day in remembrance to those who have died for our country by decorating graves with flowers, wreaths, and flags. On average, 57% of Americans will be grilling on Memorial Day. It's estimated that over 800 hot dogs will be eaten per second. That's a lot of hot dogs. Just remember that active service members and veterans, just like me, have lost friends and may be in somber remembrance this weekend. I'm going to leave you with some good news on rates from Stacy Williams, our preferred lender over at Guild Mortgage. Here's the bottom line. Home loans are showing signs of peaking, with rates hovering near current levels over the last month. Uncertainty and volatility around inflation, the Fed, and economic growth will continue to push rates and stocks around. If you are considering a purchase transaction, now is a great time to lock. This past week, home loan rates improved to the best levels this month. The 10-year note yield is beneath 2.8%. for 2 consecutive days for the first time since April 13th. Moves like this begin to suggest that rates have peaked. The main reason for the decline in rates is due to rising fears of recession. On Thursday, the second reading of the first quarter GDP showed a 1.5% contraction in economic growth. A textbook definition of a recession is 2 consecutive quarters of negative growth or contraction. Currently, estimates for the second quarter GDP sit around 1.5%. When coupled with the first quarter contraction, we will either experience a recession or something very close. We also had some corporate earnings this week, which showed high energy costs are starting to hurt the consumer. Target and Best Buy said sales of big ticket items like televisions and exercise equipment have slowed. Durable goods orders for April also showed consumers' appetite for large purchases has waned as energy prices remain elevated. A barrel of oil is at $112 despite measures like tapping the strategic petroleum reserves, and China still on a big lockdown with its zero COVID policy. There is rising concern that oil prices will move another leg higher upon China's eventual full reopening, and demand increasing sharply. Another oil spike would be unwelcomed, just as the Federal Reserve is set to raise rates by 0.5% in each of the next 2 months. Speaking of the Fed, the financial market is starting to sense the Fed will pause after a couple of rate hikes. The incoming economic data will determine how far the Fed will go. Some signs inflation may have peaked too. The 10-year inflation expectations have declined sharply in the past couple of weeks, and that too is a reason why yields and rates have declined. Seeing long-term inflation expectations decline is very important to the Fed, as they do not want to see consumers expect higher prices in the future, or it will likely happen. Looking ahead, next week brings the important jobs report. The labor market remains extremely tight, and the Fed wants to cool it off a bit without doing major damage. The last thing we want to see is rising unemployment and rising prices, hence the tough spot the Fed is in as it relates to hiking rates. The strong labor market remains bright for housing. Jobs buy homes. Until next week, I'll see you, and you have a wonderful long weekend. Do be safe. Talk soon.